So in this video, let us discuss a stock. I have chosen Divi's Laboratories because I think there is a lot to learn from this. I have rejected the stock. It is not on my watch list for today. Today is 28th of November morning 7:30. So the market will open in a couple of hours. And I have decided not to put the stock on my watch list. And I want to discuss the reasons why. Overall, it looks good, but not convincing enough for me to take the trade. Okay, so let's go to Divi's Laboratories. See, I make these videos about individual stocks to help you understand my thought process. What am I looking for in a stock? So let us log into MarketSmith as usual. So Divi's Lab. Okay. So the first thing I do when I open a stock is I click here. Okay. I click here, I click on consolidated. And then I expand the screen. This is what I do. Okay, now have a look at this stock. What are the kind of analysis that we do with each stocks? We do three kind of analysis, right? I look at comparative analysis, I do technical analysis, and I do fundamental analysis, correct? So let's do comparative analysis. Price strength is 80, which is fantastic. Accumulation distribution rating is B, which is fantastic. Group rank is 43. Well, this is a problem. I want the group rank to be less than 40, preferably less than 20. But let's see whether that group rank has improved or not. If that is the case, then we could be excited about the stock. So let's see. This is medical generic drugs. Okay. So I have this bookmark link here. So let's go to industry groups, medical generic drugs. So medical, yeah. See, 43. See, 6 months ago, the industry group rank was 74. Now it is 43, which means it has improved, which means this stock is comparatively strong because it has good relative strength, price strength. It has got institutional demand, although it is not in the top 40 industry groups, but the industry group rank is improving. So out of four factors, three are in my favor. So which means the stock is comparatively strong. I wouldn't say it is comparatively very strong because if this was less than 40 and it was improving, then I would say it is comparatively very strong. So you see, I classify stocks between strong and very strong. Okay. That's comparative analysis. Let's do technical analysis. Okay. For technical analysis, you come to the chart. This is the daily time frame chart. You see price is contracting, volume is contracting. Okay. That's exactly what we want to see. The price is above the 50-day moving average. The 50-day moving average is above the 150-day moving average, and the 150-day is above the 200-day moving average. So blue, green, red. Okay. So that's a strong stage 2 uptrending stock. Moreover, if I click here, it says stage number 2. Actually, it should say base number 2. So this stock is in an early stage in its advance. Moreover, you see the contraction in price. So let me take you to the trading view. So let's go to Divi's Labs. So this is the base. Okay, let me remove these yellow lines. I'll put a yellow line here, okay, at the high of this candle. What is the high of this candle? 6185. So let me put it 6185. So this is 0.1 in the base. Let me draw that base for you. 0.1 in the base, then 0.2 in the base, then 0.3 in the base, 0.4 in the base. I'm not taking this high because this high is higher than this high. Okay. So as you can see, there are 4 points in the base. The buy point, which is point number 3, is in the green zone, which is fantastic. Volume is contracting, price is contracting, everything is fine. Technically, it is set up very well. Let's look at the distance between the closing price and the yellow line. It's less than 5%. So fantastic. Okay. Blue, green, red, minimum 10 candles in the base. There are 4 points in the base. The yellow line, which is the buy point, is in the green zone, which is the top quarter of the base. Volume contraction, price contraction. Fantastic. What else do we want in a stock? Okay. This is technically very strong. Okay. I'm not saying strong, I'm saying very strong. Okay. Comparatively, I never said very strong. Comparatively, I said it is strong. Coming back to fundamentals. Okay. So fundamentals, you look at the recent quarterly result, recent latest quarter result. See, there was a decline in the growth rate in June quarter, but then it came back up. Now sales, if you see, 3 straight quarters it has been growing. So accelerating quarterly sales growth and accelerating EPS growth, which is fantastic. One problem with the stock I see is the number of funds, the number of institutions holding on to the stock has declined from 739 in December to 721 in September. Okay. So that's one negative. Management ownership is 51.89%. So promoter ownership, which is very good. Anything more than 50% is very good. EPS growth rate is low. Earnings stability, as long as this number is 25 or less than 25, it is fine. The smaller this number, the better. Okay. So the growth rate is small. Okay. The growth rate of the company is small. Up down volume ratio is 1.7. This has got nothing to do with fundamentals. The PE ratio is near the upper end of the PE range, which is what we want. Return on equity is less than 17%. That is one negative. Cash flow per share is positive. That's okay. Let's look at margins of the company. Sorry. Let's go down. Let's look at margins of the company. So if I look at this, in 2014, the margin of the company was 31%. Now it is roughly 21%. So basically it's gone from 30 to 20. So the margin has declined. This is not a company with expanding margins. This is a company with shrinking margins. That is a big problem. See, when return on equity of a company is less than 17%, then we should have a stock which where at least the margin is expanding. If both the return on equity is poor and the margin is shrinking, that's a problem. Okay, because return on equity talks about the efficiency with which a company uses its capital, efficiency, effectiveness, and that is weak. Less than 17% is low, it's not strong. Margin shrinking means the company is not able to keep a bigger percentage of what they are making in terms of sales compared to what they used to do 10 years ago. That's a decline in performance. That's a decline in uh, efficiency of the business. There are companies where the margins have gone from 20% to 30%. Like if you see CAMS, the margin has actually expanded in the past 10 years. So they get to keep more of what they sell. And on top of that, what they used to sell 10 years ago, they sell far more than what they sell now. Okay. So their sales have increased significantly. And not only the sales have increased, but the margin has also increased. So imagine the multiplier effect on earnings. Here, the margin is putting pressure on earnings, and return on equity is also not great. So, just because quarterly growth you see doesn't mean that the company is fundamentally strong. Moreover, very important point in William O'Neill's book, How to Make Money in Stocks, he talks about choosing companies where, at least for the past 3 years, there is at least some positive growth in EPS. It may not be great explosive growth, but at least some positive growth. Look here, 2022, 2023, 2024. So 2022, yes, the EPS has grown. There is growth from 74 to 111. But after 2022, the EPS actually declined. So forget about accelerating growth or decelerating growth. Okay. There is no growth at all. Okay. See, here you see from 67 it goes to 21, right? That is called as decelerating growth rate. Okay. From 21 it goes to 46. That is called accelerating growth rate. So at least there is growth, even if it is accelerating, decelerating. Here, if you see annual numbers, forget about growth. It's a decline. Okay. There is no growth. Then from 2023 to 2024, it declines further. So forget about growth. So what William O'Neill says is you stick to stocks where the at least there is some positive annual growth in the company in the past 3 to 5 years. We look at 3 years, we see the 2 consecutive years recently there has been a decline in the EPS, which is a big negative for the stock. Now, see, there are estimates that it will improve to 76 and then it will fall back again, but this is still an estimate. It is still an opinion. It is not a fact. It is a consensus estimate. So I take my decisions based on facts. I don't take my decisions based on opinions of other people. Okay. So fundamentally, there is a problem with the company. So this company uh, does not show the characteristics of a leader. Moreover, if you read William O'Neill's book, How to Make Money in Stocks, he talks about putting your money in the leading stocks in a industry group. So generally, if you look at any industry, the top three players always dominate. Top three players means companies with the best top three market capitalization companies or the best earnings, the best sales growth, the best earnings growth, the best margins, the best return on equity. That is why they command that much market capitalization, right? So I keep it simple. I look at market cap wise, which are the top three names. So if we look at medical generic drugs, okay, I click here. You come here, you click on stocks. Okay. You see the market cap wise, it is sorted in descending order. Sun Pharma, Divi's, and Cipla. Now, Divi's does come in the top three. What do you say? In the top three companies as per market capitalization within the industry, but the margins are declining. See, EPS rank is 66. Preferably, this should be 80 or more. So, although it comes in the top three in terms of market capitalization, although it is a leading stock in terms of market capitalization, you will notice that when I speak about the stock, you will not see confidence when I am talking about the stock because of margins, because of return on equity, because of declining EPS consecutively for the past 2 years, right? Generally, a leading stock will show improving margins, very high return on equity, positive growth every single year in the EPS, preferably high positive growth more than 25%, and accelerating quarterly EPS and accelerating sales EPS. These are the characteristics that I want to see in a company. Moreover, that company should be in the top three. So you see how refined that fundamental criteria is. Okay. And this stock does not show that criteria. That is the reason why I have not put this stock on the watch list, even though it is comparatively strong and technically very strong. Another reason is if you look at market conditions, this is the market condition history. Let it open. I don't know why it's taking time. But anyways, let us go to MarketSmith homepage. They give you the details there. Yeah, see, it says it's a rally attempt. Rally attempt means what? Okay, this has opened now. See, from 26th November till current date. So today is 28th of November. So the market trend is in this stage. So this is called rally attempt. So this is going sideways. So if this was green, if we were in a confirmed uptrend, okay, probably I would have considered buying the stock and that too with a small position size because the EPS has been declining. So what Market Smith says is during this period, it's okay to buy fundamentally strong stocks even if they're technically weak. Okay. And in this period, uptrend under pressure, it is okay to buy stocks which are fundamentally and technically strong. Okay. So the more weakness in the market, the more strict your criteria should be. So now this stock shows decline in EPS in the consecutive 2 years. So even if this was green, I would hesitate to buy the stock. And even if I had bought the stock, I would keep my position size very small. Now, in currently, it's in a rally attempt. So there is no question of buying the stock because we are neither in a confirmed uptrend nor we are in uptrend under pressure. These are the only two states when we are allowed to buy, okay, as per Market Smith. These two states we are supposed to exercise caution. This state we are actually required to sell our stocks and raise cash. So, looking at market conditions, looking at recent EPS situation of Divis, looking at the shrinking margin, looking at return on equity, I don't see the characteristics of a leader in this company, which is why I prefer to stay away from this stock because as of today, I see four or five other stocks which meet that criteria. Which so I would prefer investing my money or my energy there, not here. Okay. So I'm not only looking at a stock, I'm looking at its comparatives, I'm looking at its technicals, I'm looking at its fundamentals, I'm looking at how it is placed in the industry, I'm looking at market conditions. And based on all of this, I am taking an educated decision that I don't want to be a part of this stock at this moment, given the fact that there are other stocks where I see a better characteristics compared to what this stock is displaying. So it's not just the stock. It's also about market conditions and what other opportunities I see because I can only invest in a limited number of stocks. We cannot attend every party in town, right? So these are the reasons which I have given you because of which I feel I should stay away from the stock. Okay. So I wanted to explain to you my thought process when I'm looking at any stock. I'm looking at all the three factors: comparatives, technicals, fundamentals. If the market were in a confirmed uptrend, my thought process would be slightly different. I would not be as strict as I am on this stock at this moment. So, market conditions also play a huge role in my overall analysis. I hope this video has added value to your trading journey. Thank you so much for your time. Thank you so much for your support. Have a fantastic day today.